Hello, welcome to Capital Sensei. Today, we're going to dive deep into one of the most important business books ever written for investors, The Outsiders by William Thorndike. We'll unpack the core idea of what makes an outsider CEO, explore the master skill of capital allocation that sets them apart, and walk through the incredible stories of the 8 unconventional leaders who crushed the market by following a very different playbook. This is about learning to spot the true creators of value, not just the famous faces. Whenever we can, we answer questions in the comments. The ideas in this book can be a real paradigm shift, so I'm sure you'll have some thoughts. Please share your questions, your own investment stories, or even your favorite examples of great CEOs in the comments below. Building a community where we can all learn from each other is the best way to grow our financial knowledge. So, let's start with a simple question. When you think of a great chief executive officer, a great CEO, what image comes to mind? For many people, it's a charismatic, visionary leader. Someone who gives inspiring speeches, is a regular on financial news channels, and is always on the cover of business magazines. Think of someone like Jack Welch, the legendary CEO of General Electric during its heyday in the 1980s and 90s. He was the prototype, the celebrity CEO that everyone wanted to be. But William Thorndike's book proposes a radical idea. It argues that the truly exceptional CEOs, the ones who delivered the absolute best long-term returns for their shareholders, were the polar opposite of this archetype. They were quiet, analytical, often unknown, and intensely private. They were outsiders. They didn't care about Wall Street's approval or the size of their empire. They cared about one thing and one thing only: increasing the per-share value of their company over the long run. Thorndike identifies a core truth that is often overlooked. A CEO has 2 fundamental jobs. The first is running the day-to-day operations of the business, making sure the factories are efficient, the products are good, and the customers are happy. The second, and arguably more important job, is allocating the capital that the business generates. This second job, capital allocation, is the central theme of The Outsiders and the key skill that separated these 8 titans from their peers. What exactly is capital allocation? Let's make this simple. Imagine you own a single, highly successful coffee shop. Every month, after paying for beans, milk, rent, and your employees, you have a pile of cash left over. That's your profit. Now, you have to decide what to do with that pile of cash. This decision-making process is capital allocation. You have a handful of options, and the choice you make will determine the future success of your small enterprise. You could reinvest that money into your existing coffee shop. Maybe buy a new, faster espresso machine to reduce customer wait times, or renovate the seating area to attract more people. This is like a company investing in its own organic growth. Or you could use the cash to acquire the struggling bakery next door, hoping to combine the businesses and sell more pastries with your coffee. This is an acquisition. Another option is to pay down the loan you took out to start the shop, reducing your debt and interest payments. You could also choose to take some of that cash home as a reward for your hard work, which is similar to a company paying a dividend to its shareholders. And finally, there's one more option, and it's a crucial one. Let's say you believe your coffee shop is the best investment in the entire town. You could use your profits to buy out a small partner who wants to sell their stake, increasing your own ownership percentage. This is the equivalent of a stock buyback. These 5 choices, investing in operations, acquiring other businesses, paying down debt, paying dividends, and repurchasing shares, are the tools in a CEO's capital allocation toolkit. The genius of the outsider. CEOs was their almost fanatical, rational approach to choosing the right tool at the right time. They treated the company's money with the same care and prudence as if it were their own personal savings, because in many cases, a large chunk of it was. The book analyzes the careers of 8 of these CEOs and measures their performance against 2 benchmarks, the S&P 500 index and the performance of the celebrated Jack Welch at GE. The results are staggering. On average, the outsiders' companies performed 20 times better than the S&P 500 and 7 times better than GE. These weren't just good CEOs. They were in a league of their own. Let's begin with the figure Thorndike presents as the grand master of this discipline, Henry Singleton of Teledyne. Singleton was a brilliant engineer with a doctorate from MIT. He co-founded Teledyne in the early 1960s and embarked on a breathtaking acquisition spree. For about 9 years, he used Teledyne's own stock, which was trading at a very high price-to-earnings multiple, as a currency to buy over 130 different companies. Think about that for a second. He was using his own expensive paper to buy other companies' solid, tangible assets. It's like having a rare, hyped-up rookie baseball card that everyone thinks is worth $1,000, and using it to trade for a whole collection of proven, Hall of Fame, vintage cards that are currently undervalued by the market. You're trading hype for real, durable value. That's what Singleton did. But here's where his genius truly shines. By the late 1960s, the market soured on conglomerates like Teledyne, and its stock price plummeted. What did Singleton do? He completely reversed course. He stopped all acquisitions and began the single most aggressive stock buyback program in corporate history. From 1972 to 1984, Singleton used Teledyne's immense cash flow to repurchase over 90% of its outstanding shares. He recognized that the best investment on the planet was now his own company. Why buy another business when he could buy back shares of his own collection of excellent businesses at a massive discount? This single-minded focus on buying low, whether it was other companies or his own stock, generated mind-blowing returns for the shareholders who stuck with him. Over his tenure, $1 invested in Teledyne grew to $180. That's an annualized return of over 20% for nearly 3 decades. Singleton was also a master of decentralization. Teledyne was a sprawling industrial giant, but its corporate headquarters was laughably small, with a staff of fewer than 50 people. He hired talented managers to run the individual companies he bought, gave them enormous autonomy, and only asked that they send their excess cash back to him. He didn't care about corporate synergy or endless meetings. He cared about cash flow, and he put that cash to work with unparalleled skill. Next, we have John Malone of TCI, or Telecommunications Incorporated. Malone, known as the Cable Cowboy, was a financial wizard who transformed the cable television industry. His approach was radically different from his peers. While other companies were obsessed with showing high net income or earnings, Malone thought that was for fools. He understood that for a capital-intensive business like cable, reported earnings were a meaningless fiction. Why? Because to build a cable network, you have to spend a ton of money up front. The accounting rules allow you to depreciate those assets over time, and the interest on the debt you use to build it is also an expense. These are non-cash charges that reduce your reported net income, making it look like you're not making much money. But the actual cash flow, the green stuff pouring into the bank account every month from subscribers, was enormous. Malone's strategy was to focus entirely on maximizing cash flow per share, or what is often called EBITDA, earnings before interest, taxes, depreciation, and amortization. He used debt aggressively to acquire smaller cable systems, creating enormous scale. The interest and depreciation from these acquisitions would then shelter the company's cash flow from taxes. He famously joked that TCI was a tax-exempt entity. He wasn't doing anything illegal. He was just a master at using the tax code to his advantage. His philosophy was to build scale, minimize taxes, and use the resulting gusher of cash flow to buy more cable systems, creating a powerful, self-reinforcing cycle. He completely avoided paying dividends, arguing that he could create far more value for shareholders by reinvesting that capital at high rates of return within the business. And he was right. During his leadership, TCI generated an annual return of over 30% for its investors. Of course, no discussion of master capital allocators would be complete without Warren Buffett of Berkshire Hathaway. While most people know Buffett as the world's greatest investor, Thorndike frames him as perhaps the world's greatest CEO and capital allocator. Berkshire Hathaway itself is his masterpiece of capital allocation. He started with a failing New England textile mill, a truly terrible business. But that failing mill still produced a little bit of cash. Instead of pouring that cash back into the dying textile business, Buffett made a brilliant outsider move. He used the cash to buy into much better businesses, starting with insurance companies like National Indemnity. This led him to discover the magic of insurance float. Let's break down float. Insurance companies collect premiums from customers today, but might not have to pay out claims until months or even years later. This pool of money they hold in the meantime is the float. It's essentially a massive loan that they get to invest for their own profit. And the best part? If they run their insurance business well, the cost of this loan can be zero or even negative. It's like someone paying you to hold their money. Buffett used this ever-growing river of float from Berkshire's insurance operations as a permanent source of capital to buy wonderful businesses at fair prices, like See's Candies and the Washington Post. Like Singleton, Buffett is a firm believer in decentralization. Berkshire Hathaway's world headquarters in Omaha, Nebraska is famously tiny. He buys great companies run by great managers, and then leaves them alone to do what they do best. His job, as he sees it, is to take the excess cash those businesses generate and redeploy it into the most promising opportunities available, whether that's buying another company outright or purchasing stocks in the public market. The result is the greatest wealth creation machine in modern history. Then, there's the remarkable story of Katharine Graham at the Washington Post Company. She is a fascinating case because she wasn't a finance person. She took over the company in 1963 after the tragic death of her husband. She felt unprepared, but was determined to be a worthy steward of the family business. Her genius was in recognizing her own limitations and seeking out the best possible help. She famously developed a close friendship and mentorship with a young Warren Buffett, who had become a major shareholder in the Post. Guided by Buffett's logic, Graham made two transformative capital allocation decisions. First, when the Post stock was trading at a huge discount to its intrinsic value in the 1970s, she initiated a massive share buyback, repurchasing 40% of the company's shares. This dramatically increased the value for the remaining shareholders. Second, she understood that the core newspaper business, while a fantastic cash cow, was in a mature industry with limited growth prospects. Instead of foolishly reinvesting all the profits back into the newspaper, She used the cash to make a series of shrewd, non-media acquisitions, including a company that owned vocational schools and television stations. These businesses earned much higher returns on capital than the newspaper could. Her rational, unsentimental approach to deploying capital led to a 44-fold increase in the company's value during her tenure. Another master of the playbook was Tom Murphy of Capital Cities Broadcasting. Murphy was, in many ways, a role model for Buffett himself. His mantra was extreme decentralization and operational efficiency. He ran a media empire with a tiny corporate staff, trusting his local station managers completely. He was famously frugal, a trait shared by nearly all the outsiders. His focus was always on cash flow and margins. Murphy's crowning achievement was the audacious acquisition of ABC in 1985. Capital Cities was only about 1/4 the size of ABC, making it a classic case of a minnow swallowing a whale. But Murphy knew that ABC was bloated and inefficient. He sold off non-core assets, ruthlessly cut costs, and imposed his lean, decentralized operating philosophy on the combined company. The result was a media powerhouse that generated spectacular returns for 2 decades. His simple rule was, hire the best people and leave them alone. We also have Bill Stiritz of Ralston Purina. Stiritz was the king of the spin-off. He took over what was a sleepy food conglomerate, known mostly for pet food and Czech cereal, and realized it was a collection of disparate businesses that weren't being properly valued by the market. His solution was to systematically break the company apart. He spun off the animal feed business. He spun off the company that made Eveready and Energizer batteries. He spun off the cereal business. He even spun off a protein technologies company. Each time, he unlocked immense value. Shareholders who started with a single share of Ralston Purina ended up with shares in multiple, focused, and more dynamic companies. Stiritz understood that sometimes the best way to create value is not by buying, but by selling or spinning off parts of the business to let them thrive on their own. Then there's Dick Smith of General Cinema. His story is a masterclass in adapting to a changing world. He started with a chain of drive-in movie theaters, a business that was in terminal decline by the 1960s. A conventional CEO might have tried to fight a losing battle. But Smith, the outsider, recognized the reality. He began systematically harvesting the cash flow from the declining theater business and redeploying it into a completely unrelated and far more profitable industry: beverage bottling. He built the largest independent Pepsi bottler in the country, a fantastic cash-generating business. But he didn't stop there. He later sold the bottling business at a huge profit and redeployed that capital once again, this time into specialty retail by acquiring the luxury department store Neiman Marcus. His career was a continuous journey of moving capital from low-return areas to high-return areas, regardless of the industry. He was completely unsentimental about the businesses he was in. He was only sentimental about generating high returns on his capital. Finally, we have Bill Anders at General Dynamics. Anders was a former astronaut who took the helm of the giant defense contractor in the early 1990s. Just as the Cold War was ending and the defense budget was being slashed, the company was bloated and involved in too many different areas. Anders brought a laser-like focus. He declared that General Dynamics would only stay in businesses where it was number 1 or number 2 in the market. He proceeded to sell off many of the company's famous divisions, including Cessna Aircraft and its missile division. This was shocking to the industry establishment, but Anders was unemotional about it. He took the billions of dollars in cash generated from these sales, and instead of making a foolish acquisition, he returned it all to shareholders through massive special dividends and aggressive share buybacks. He shrank the company to grow its value, and the stock price soared, rewarding investors who trusted his rational strategy. So, when you look at these 8 stories together, a clear pattern emerges. This is the outsider playbook. First and foremost, capital allocation is the CEO's most important job. They thought of themselves more as investors and capital allocators than as managers. They began each day by asking, what is the best way to deploy our company's resources today? Second, their primary goal was always to maximize value per share, not overall company size or revenue. They would rather own a smaller, more profitable company with fewer shares outstanding than a massive empire that was barely profitable. This is a critical distinction. Growth for the sake of growth is a trap that many CEOs fall into. The outsiders were immune to it. They understood that the numerator, profit, is important, but the denominator, the number of shares, is just as important. Third, they were masters of cash flow. They knew that cash is a company's lifeblood, and that reported earnings can often be misleading. They focused on generating as much cash as possible, and were incredibly disciplined in how they spent it. This often meant running incredibly lean, frugal operations, a stark contrast to the lavish corporate perks common at other large companies. Fourth, they were patient opportunists. They would sit on cash for years, waiting for the perfect pitch. But when that pitch came, whether it was their own stock trading at a ridiculous discount or a perfect acquisition target becoming available, they would swing for the fences. They were not afraid to be bold and contrarian when their analysis told them they were right. Fifth, they practiced radical decentralization. They hired smart, independent managers and gave them the freedom to operate. This freed up their own time and mental energy to focus on the big picture decisions of capital allocation. They didn't believe in bureaucracy or endless layers of management. Finally, they were different. They were independent thinkers who ignored the fads and fashions of Wall Street and the business press. They followed their own internal scorecard, which was based on logic, mathematics, and long-term value creation. Their focus was relentless. For us, as everyday investors, the lessons from the outsiders are incredibly powerful. This book gives you a new lens through which to view companies. When you're researching a potential investment, don't just be swayed by a charismatic CEO or a hot new product. Dig deeper. Look for the outsider mindset. Ask yourself, what is this company's capital allocation strategy? Read the annual reports and shareholder letters. Does the CEO talk about creating per-share value? Look at their track record. Do they buy back stock? If so, do they do it when the price is low? Or are they just trying to prop up the stock price? When they make acquisitions, do they overpay? Or do they find synergistic deals that actually create value? Do they pay a dividend? And if not, do they have a good reason and a better use for that cash? Looking for companies led by CEOs who think and act like owners is one of the most effective strategies for successful long-term investing. The Outsiders provides the definitive roadmap for what that looks like in practice. It teaches us that true genius in business isn't about fame or charisma, but about a relentless, rational, and often quiet dedication to allocating capital in a way that creates extraordinary, enduring value.